Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Heung, Senior Investment Strategist with Standard Chartered Bank's CIO office, and welcome to this episode of Through the Noise. This week, we have quite a lot of headlines from the US. Surprise, surprise, data side has been one of the interesting ones, as it seems hard data remain hard while soft data stays soft. Meanwhile, Trump is facing legal challenges in the court for his tariff policy, and the market is looking for implication from the big and beautiful budget bill. So to help us navigate through these headlines and find investment opportunities, I have Fook Hien, Senior Investment Strategist at our CIO office, to join me in this discussion. Welcome, Fook Hien. The first question I would shoot to you is that in the weekly, we actually asked reader to focus on hard data. Maybe you can give our audience a bit more explanation of what do we mean by hard and soft data and what are the significance of it.
Yeah, thanks so much, Ray. So global equities, they broke out into a record high this week. The stocks, they have more than recovered the lost ground since President Trump launched and then scaled back his Liberation Day tariffs in early April. So although trade tensions have resurfaced, we think that concerns about an all-out trade war have eased, especially after this week's call between Trump and China's President Xi. So trade tensions have been fluctuating, rising and then easing since Liberation Day. We see that this week Trump has doubled the US tariff on steel and aluminum imports to 50%. But we also see him facing court challenges, as you say, against the tariff, and also some criticism that he has gone soft on trade. So this has led to weaker soft data that we see. Soft data are usually based on surveys. For instance, the US business confidence indicators, or the PMIs, have continued to weaken. The US ISM manufacturing PMI for May, it missed expectations, remaining contractionary. Meanwhile, the ISM service sector PMI, particularly the new orders component, they turned contractionary for the first time in almost a year, while prices paid continued to rise. On the other hand, despite your weak soft data, the so-called hard real activity indicators have remained resilient, and this is likely supporting household consumption. So one of the timeliest job market indicators is the initial jobless claims. This is rising, but it has averaged around 235,000 in May. And this is well below levels that would signal a recessionary conditions. The 2007 to 2009 Great Recession, it was triggered after US claims rose to around 350,000. So an important data to watch is the upcoming hard data for May in the form of your US non-farm payrolls and inflation, which will provide the first signs of the impact of US tariffs on real economic activity. The consensus estimate is for US net job creation slowing to 126,000 in May. Now, a significant miss in the payrolls data, if it is followed by relatively stable inflation data next week, could raise the prospect of the Fed resuming rate cuts from July. And this could potentially drive US equities to a new record high. On the contrary, any tariff-driven surge in inflation would delay rate cuts, leading to a short-term consolidation in equity markets. The consensus estimate we see is for May core inflation to rise by 2.9% year-on-year or by 0.3% month-on-month. However, we do not expect a significant pullback in equity markets as investor positioning in US equities remains bearish.
Thank you, Fook Hien. Let's stay in the US for a while. Move on to the US budget. Can you give us a little bit of a deep dive into what we are paying attention to and what are the implications for the President Trump's big and beautiful bill for the US equity?
Yeah, sure. Trump's big, beautiful bill, it could potentially upset bond markets if it is passed in its current form. This is given the soaring deficit projections. So we do expect a cutback to some of the tax incentives, and this is what we will watch out for. For the implication on US equities, our view is to add exposure to US equities on pullbacks. The bill currently, it is net earnings positive. It benefits corporate earnings by extending existing tax cuts and also making certain R&D and capex spend and more interest expense tax deductible, while it will also be reducing tax on foreign income. On the flip side, the withdrawal of green energy credits, these could negatively affect earnings. There are other government policies as well, such as your tariff and immigration restrictions. These could negatively impact earnings, while the concerns about the fiscal deficit could actually reduce US equity valuation. Then there is a Section 899 of the bill, which implies higher withholding taxes on dividends for some foreign holders of US equities. Now, this might reduce the attractiveness of dividend-yielding stocks relative to non-dividend paying growth stocks. We expect to see upside in US equities underpinned by the growth sectors, and we do favor your US-listed semiconductor and the technology software sectors. Investor positioning also has room to normalize further, and lower market volatility could drive flows back to US equities.
Thank you, Fook Hien, again. Our next stop is Japan. With the recent weeks rising in the Japanese long bond yields, what is the implication to the Japanese insurers?
Yeah, our view here is to add to the Japanese insurer bonds on any weakness. The impact of rising bond yields on solvency and profitability is not material. This is due to Japanese accounting principles governing the treatment of domestic bond holdings. There are some reports which indicate that Japanese insurers have been purchasing longer dated Japanese government bonds or JGBs, and these investments in JGBs pose a risk to their financial position due to the rising bond yields. We note that the increase in JGB yields has led to significant unrealized losses. However, these have been partially offset by substantial unrealized gains in the insurers' equity portfolios accumulated over the years. Now, from an accounting perspective, the insurers' liabilities typically have longer duration than their assets. Consequently, an increase in interest rates would reduce the present value of these liabilities, potentially leading to mark-to-market gains and an increase in shareholders' equity. However, most Japanese insurers recognize their yen-denominated liabilities and bond holdings at book value using the amortized cost method under the Japanese accounting principles. This would minimize the impact of fluctuating JGB yields on their capitalization and earnings. Furthermore, insurance liabilities, they are more stable than bank deposits and are lowering the likelihood of forced asset sales during periods of market stress. Insurers also tend not to use leverage in their investment portfolios, further reducing the risk of a disorderly selling in the JGBs.
Next, we're flying to Hong Kong. And late May, there's a key Hong Kong property developers opt to defer its coupon payment for its perpetual bonds. Do you see any spillover impacts to the Asia dollar bonds?
Yeah, Asia US dollar bonds, they remain a core holding to us. This payment deferral by a Hong Kong property developer is an idiosyncratic event. So this decision by the Hong Kong developer to defer coupon payment, it has led to markdown in the developer's perpetual bonds, and perpetual bonds from other Hong Kong property developers have also dropped in sympathy. We believe this negative price reaction is primarily linked to the specific liquidity issues of this particular developer, and the spillover impact is not going to significantly affect other Asian bonds. Most other Hong Kong developers are rated investment grade, and they have stronger credit metrics compared to the developer in question. And lastly, the total weight of Hong Kong property developers' bonds in the Asia Bond Index is low at just 1.4%.
Okay, thanks. And the round-the-world trip on this episode stops at Europe. What is our view on Euro following the latest ECB meeting?
Sure. I mean, we are bearish on the euro to the Japanese yen amid diverging inflation and policy rate trends between the euro area and Japan. So the ECB this week, they cut its deposit rates by 25 basis points to 2%, which was expected. The ECB also revised its inflation forecast for 2025 lower to 2% from 2.3% expected back in March. For 2026, the average increase in consumer prices is projected at 1.6% compared to previous rate of 1.9%. And for 2027, ECB maintained its inflation forecast of 2%. Now, against this disinflationary backdrop, we see risk of further policy easing in the second half of this year, especially if the US reinstates reciprocal tariffs after the latest pause. So we see the euro to the US dollar falling towards 1.125 this week, which is its 50-day moving average level. However, we see more compelling value in a bearish euro to Japanese yen idea. We see further strength in the Japanese yen on safe haven demand due to ongoing trade and global growth uncertainty. And we expect the Bank of Japan to continue hiking rates as Japan's inflation continues to run above its 2% target. Japan's recent consumer inflation exceeded expectations. So technically, a firm break in the euro to the Japanese yen pair below 162.5, this could pave the way for a test of 158.3.
Thank you, Fook Hien, for the comprehensive sharing. And that's all the time we have for the episode. Thank you for listening, and please stay tuned to our next episode of Through the Noise. Bye now. Thank you.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.